Welcome back, everyone, to the second half of day 3 of the Digital Ecosystem Week right here at the Malaysia Tech Month 2021. Hope everyone stays safe and healthy in light of the pandemic that's still among us. Has it been taxing for you talking about healthcare before the break? Well, join us as I welcome the next panel session entitled Tax Management and its Implication to MNC Companies. Moderating this session is Datuk Harjit Singh Sidhu, Chief Executive Officer of HSS Advisory, Sdn Bhd. And also, we want to mention that Datuk has 30 years of working experience in the field of taxation. Datuk Harjit is a regular speaker mainly in the area of corporate advisory, compliance, tax audit, and investigation. So over to you, Datuk Harjit.
Good afternoon, everyone. Welcome to a session by Malaysia Tech Month. The topic today will be on tax management and its implication to MNC status company. We are privileged to be here, and a special thank you to MDEC for inviting us here today to present a topic that we feel that it is close to the heart of many taxpayers, being the owners of the company or even the investors who would like to know about the tax issues as far as companies that have tax incentives. And with me today, I have two distinguished speakers. They are none other than Madam Theresa, who is currently the Senior Transfer Pricing Partner from Deloitte. And she has been in the field of taxation for the last 30 years, extensively involved in transfer pricing for the last 18 years. And she's seen as one of the leaders as far as transfer pricing is concerned in Malaysia. And we are privileged to have her with us today here. And the second speaker, it's honor to have her. She's an ex-IRB director, Puan Amnah binti Tawil. She too have about 30 over years experience in the field of taxation. She have done practically everything as far as tax is concerned in the last 30 years, right from an assessment officer to an investigating officer, the head of investigation, and her current position was as the Selangor State Director of LHDN. So I have both of them with me here, and the topic that we're going to discuss today is a tax implication, all right, and the management as far as the company is concerned. So Theresa will probably, we will have an interactive session, Theresa and Puan Amnah. We will be discussing on areas of concern. So Theresa, your areas of specialization has always been transfer pricing, and I believe that this is one of the areas that could be very, very important, irrespective to whether you have got tax incentives or you have no tax incentives. Transfer pricing is the in thing now. And then a lot of changes has happened recently, and more so this year in January, where transfer pricing has become as an area of extensive importance, which every company should consider. So Theresa, I pass it to you, and we can start the session going, and then we will have a chat in between while you're giving your views. Back to you, Theresa.
Yeah, thank you, Dr. Harjit. Good afternoon, everybody. Yeah, it's good to join you in your tech session of the month. So like Harjit says, I will be talking more about transfer pricing. So the transfer pricing landscape in Malaysia has changed quite a bit, and especially for MSC status companies or tax incentive companies, it has changed a lot dramatically, right? So it is very important that you listen to us and really be aware of these changes, and and then realize what you need to do. So I think the first thing, I suppose, as a MSC status company, in the past, before all these changes in the law, before 1st of January 2021, most tax incentive companies are not too worried about transfer pricing, right? So, I mean, what's the issue? If IRB, finds that my profits or my prices are not at arm's length, they can make adjustment. But even if they were to make adjustment, I'm still fine because I'm still tax exempt, right? And our penalty regime in the past is tagged based on additional tax payable. So if I'm tax exempt, there is no tax payable, there won't be any penalty as well. So, so taxpayers with tax incentives have never really been bothered about preparing TP documentation, and whether they, look at whether it's arm's length or not. I think it depends very much on the conditions and whether they actually follow that. But I think with all the changes that has happened this year, incentive companies no longer have the choice, all right? So I think the first question for us to consider is, Do MSC companies have to comply with our Malaysian, transfer pricing regulations? Do you have to comply? I think the first thing we will probably have to look at is look at the your approval letter for MSC status. There is a condition that says that you are required to comply with TPE legislation, the income tax rules, the transfer pricing guidelines in Malaysia, etc. With regards, as long as you have transactions with associated companies, then you need to comply. So that's what is stated in your conditions, all right? And then we look at the Malaysian transfer pricing guidelines, all right? So what do the guidelines say about tax incentive companies? So the guidelines as it stands says that companies are encouraged, right? So if a person that is not accessible and chargeable to tax due to a tax incentive, right? So if you are not accessible and chargeable to tax due to a tax incentive, then you are encouraged to prepare TP documentation, right? So it doesn't say that you are required to, it says that you are encouraged to prepare TP documentation. So what does this mean? Now, when the amendments came out this year, we had several conversations with policy division, transfer pricing policy division of IRB. We spoke to the enforcement divisions as well, and they seem to have two schools of thought, right? So one side is thinking that, well, our guidelines only say that you are encouraged to prepare. So if you don't prepare, then we cannot penalize you for not preparing. But another arm is saying, as long as you have cross-border related party transactions, you have to prepare. You have to demonstrate that your transactions are arm's length, and you can't do that unless you prepare a TP doc. All right. So this is the uncertainty that surrounds this matter, and I think it's good that MDAC gives us an opportunity to highlight all these issues, because it is important for MDAC to also get clarification from NCI, from IRB, right? So that the taxpayers with MSC status will know for sure what exactly it is that they need to do.
Interestingly, Theresa, you have mentioned quite rightfully, most MSC companies, they are of the view that if they have got tax incentives, they don't have to comply with any of the regulations. But moving forward, I believe that the MSC companies or even a tax incentive company should prepare the TP documents. What are your views on that? Is it, you said they're encouraged to do it, but as of this year, is it encouraged or they must do it?
Yeah, so the guidelines have not been amended yet. So as it stands, technically, you are not required to do it, right? But then, where your incentive conditions are concerned, it is also written that you need to comply, right, with TP regulations, guidelines, etc. And the basic is that you need to follow the arm's length principle, right? So how can you demonstrate that you are in compliance with the arm's length principle unless you prepare TP documentation, right? So in a way, it may be necessary for you to prepare it, but actually under our guidelines, technically you are not. I guess it comes to the question of penalty. So I will touch a little bit on the new provisions with regard to penalty in a short while, all right? So if we go back to this question of if you need to prepare, then what exactly do you need to do, right? Our guidelines actually set out some threshold. And I guess for MSC status companies, all of you will probably be above this threshold. So the threshold is gross income, 25 million, plus controlled transactions or transactions with related parties in total exceeds 15 million ringgit, right? So these are very small numbers, right? 25 million in terms of turnover, 15 million in terms of total related party transactions. So I guess most, or if not all, MSC companies would exceed this threshold. And for financial assistance, let's say you get loans and all from your related parties, the threshold is 50 million ringgit. Now, if you exceed this threshold, then the requirement is that you prepare a full transfer pricing documentation, right? With all the details of your functions, your assets, your risks, how you justify that your transactions are at arm's length, etc. Okay, and with regard to the documentation, if you prepare year one, now Malaysia is lenient, right, in the sense that it allows 1+2. So what is 1+2? It means the first year that you prepare a full TP documentation, if you don't have any material changes into your business, to your shareholders, etc., then the next 2 years, you can actually just do an update on the benchmarking. So that will help, to save a lot in terms of compliance costs.
Theresa, one question, Theresa. If it's a multinational company And assuming if they have done their international transfer pricing agreement, do they still have to comply with the Malaysian transfer pricing rules? Do they have to do a separate transfer pricing agreement in the context of Malaysia, or can they use the master transfer pricing agreement that they have?
Yeah, not so much of agreement, but documentation. So multinationals, you've got global groups, right? So quite often they will prepare global TP documentation centrally as well, right? So this is global TP documentation, right? And then on our local requirement, we have local TP documentation requirement, right? So I think the question is, will RB accept, you know, the global documentation that is prepared, right? Do they still need to put in the effort to prepare local documentation? Perhaps Puan Amnah can shed some light on this. Puan Amnah was also formerly a director in the CCM, or Cawangan Cukai Multinationals, that was handling transfer pricing audits.
Okay, Theresa, what is the requirement of IRB is your TP dot has to be able to be verified by IRB. So if you use comparables, which is comparables, which is from other jurisdiction, and IRB could not verify the documents, so we cannot accept it. So it is advisable that you use a local comparables, so local TP for the purpose of IRB. Yeah.
Yeah, that's right. We actually had a case where the taxpayer did not prepare local TP documentation. Where the benchmarking study is concerned, they also didn't use Malaysian comparables, but they only relied on the global one that's done. And since this is a UK company, the comparables were actually more European comparables, right? Not Malaysian. So when they were audited by the IRB, the maximum penalty was imposed on them as if they did not have a TP doc. Okay, because the IRB's requirement is that you need to have specific documentation for the local entity, and you need to incorporate all the local details, right? Like exactly what's the local subsidiary's business, right? Who are your suppliers? Who are your customers? You know, and exactly what kind of activity you do, etc. And of course, they require local comparables as well. Okay.
So the take here, Theresa, I believe is you cannot rely on your global TP documentation. It must be back to the Malaysian jurisdiction, and the Malaysian law has to be applied, and the comparables should be local comparables. So I think the point to take here, Theresa, I believe for those who are listening or those who are having this tax incentive is to consider the Malaysian TP document as a primary documentation to defend any form of tax audit or tax query by IRB as far as transfer pricing is concerned. So I think that's a very good point, Theresa. And probably you can share us a bit more of your thoughts and your experience.
Yeah, I think we need to look at penalties, right? Then you will understand why, you know, this question becomes so important. Yeah, whether you are required to prepare or not required to prepare. This amendment with regard to penalties, previously, what we have is that the penalty will be applied based on your tax payable. So if there is a TP adjustment, if they find that, okay, your profits are not at arm's length, too low, then they make an adjustment upwards. So that will be subject to 24% tax. And then your penalty, let's say it's 25%, will be applied, calculated then on the additional tax payable, right? So from 1st of January this year, this penalty regime for transfer pricing adjustments have totally been changed, okay? This is now, the fine is now 20,000 to 100,000. Okay, if you fail to furnish your TP documentation, see, when do you have to furnish your TP documentation? You have to prepare it by the time you file your tax return, your tax return, corporate tax return filing deadline. That's the deadline for you to prepare the TP documentation. But to file the documentation or to provide it to IRB, the deadline is 14 days upon request. So when the IRB writes to you and requests for the TP documentation, you are given 14 days to provide. Now, if you fail to provide within 14 days, what's going to happen is that a penalty will be imposed. This penalty will be 20K to 100K. So it's a range, of 20 to 100K per year of assessment, right? So for transfer pricing, the statute of limitation is 7 years. So it's very common for IRB to ask for TP doc for 5 years, 6 years, 7 years. All right. So if, for example, if it's 5 years and they impose the minimum fine of 20,000, then it will be 20 times 5 is 100,000. Even before IRB starts audit, right? you fail to furnish your TP doc, right, within the 14 days, there's already a fine of 100,000. So it can be hefty, and that's the first offense, right? A few years later, if IRB comes back in for another round of audit, and then you're still, you still have not complied, you've not prepared your TP documentation, then penalty maybe perhaps could already be 30,000 or so, right? So it's going to be quite hefty, right? But fine, I suppose, for CFOs, directors, maybe it's not so bad lah. The company bears the fine, right? Another option for IRB is imprisonment, right? 6 months imprisonment. When we have this webinar together with IRB for our clients, this was of greatest concern to the people. The question is 6 months. 6 months. If I have 5 years being picked up by IRB and I'm late for all the 5 years, so the jail term is 6 months, Saja, or 5 years times 6 months, which is like 5 times 6, 30 months jail, right? So that was one of great concern. The second issue was actually who goes to jail. Yeah, so Datuk Harjit, according to our section 2, Puan Amnah, who goes to jail?
Yeah.
Director. But is it just the director? It's also any other person acting in the capacity of director, right? Could be the CFO, could be anyone who's in charge of actually signing off the tax return form, being responsible for the financial affairs of the company, etc. So it's become so important that the question is it worth taking the risk or not, right? So you need to have clarity on this. And hopefully you have clarity soon. Even if you don't have clarity, I think maybe it's worthwhile for you to just prepare your TP documentation anyway, right? Because of the amount of money involved and the potential jail term.
But how about startup companies, Theresa? Those who have got incentive by their startups, their turnover is not so high. They don't have much related party transaction. They're all below the threshold. So do they have still to prepare a transfer party documents?
Yeah,
or they can go away with it?
Right. I think that's a good question, because that is one area where a lot of taxpayers misunderstand, right? They don't understand that part. The threshold is actually for determining the type of TP documentation that you prepare, how much details you need to put into the TP documentation. It is not for deciding whether you need to prepare or not, right? It's more the how much work you need to do, yeah, with regard to your TP documentation. So if you are below the threshold, like the startups that you mentioned, then what they need to do is a more simplified version. So the guidelines allow you to prepare a more simplified version, description of the related party transactions, description of your business, right? And then also for your related party transaction, find some way, some method to justify that they are at arm's length. So it's a much more simplified method, yeah, compared to a full TP documentation.
So I believe the startup companies, assuming if they were to be picked up for transfer pricing, and assuming they have not done the documentation, looking at the range of penalty from 20,000 to 100,000, is there a room for mitigation for companies like this? Can they mitigate with IRB and say, look, we are a startup company, we don't have much, what they call, or probably a knowledge or no advice was given by, irrespective to whether it's their tax consultants or even from IRB, can they do a mitigation on their penalties, or is the penalties fixed?
Unfortunately, if you want to appeal against this penalty, the appeal has to be to SCIT, Special Commissioners of Income Tax.
Okay.
Right? So not so simple. So I think where IRB is concerned, the discretion for IRB is between the 20 to 100,000. How do you decide, right? Whether it's 20K or 100K. And when in talking to IRB, when they look at whether it's 20K or 50K per year of assessment, they will also consider not only the timeliness with which you submit your TP documentation, but they will also consider the quality of your TP documentation as well, right? Our Malaysian TP guidelines actually sets out, the list of information or details that needs to be incorporated into a TP documentation, right? So just having the subtitles in the TP doc alone is not good enough, right? I mean, there's got to be adequate and explanations and all that given as well.
So Theresa, as tax consultants, right, we have to advise our client to tick the box in the Form C that we have, the column. So now some companies, they may not have prepared. Of course, the rule of the law is if it's not prepared, you must say no. So will that trigger an automatic tax audit for those who have ticked no during this compliance period when they have to actually comply with it?
Right. Maybe what I'm not can add on, but I wouldn't say that it's automatically they will be picked up for audit just because they take a no, right? So the next column after that, right, is actually where your related party transactions need to be disclosed. So you have to disclose all the different types of related party transactions, the amounts, etc. And I think as far as I know, IRB does their risk assessment. So in their risk assessment, as to whether this is a high risk case or not for them to pick up for audit, I mean, one of the factors would be, yes, they have substantial related party transactions, but they have not prepared a TP doc. So this would be one of the factors, together with other factors, right? Then they decide whether this is high risk or not. But it definitely is one of the contributing factors.
Yeah.
Definitely, it's being picked up by the computer. Yeah. So it's risk analysis. It doesn't involve human interventions. So when they list down what are the risks, it's done by the IT people. Yeah. So if you don't take it, definitely, and we'll see the number. So how many companies the IRB wants to audit this year? If it's too much, they will reduce it, or they will put in more criteria so that the number become less. So that's how audit risk analysis has been done. It's all done by computer.
Yeah. I think you brought up a very good point there, Dr. Harjit, because you see, in addition to disclosing what is right? If you don't have TP doc and you disclose yes, then that is actually an offense against the law as well, right? That's an offense. And as a result of that offense, if IRB were to say that, well, that is negligence at best, right? If not, it's fraud or willful default trying to, then, what's going to happen is that the time bar, the statute of limitation will not protect you. Okay. So instead of just IRB looking at 7 years, they can actually, go back as many years as they want. Okay. So that's, so that would be a serious offense, actually, I would say.
So Theresa, your advice to all these tax incentive companies are that moving forward from now, assuming if they have not done their TP documentation, I believe MDEC also have put into their point of reference that moving forward, every company should consider transfer pricing documentation. So this become a paramount issue for not only startup companies, but also for going concern companies. The way forward is TP will become a primary requirement. So your advice to all tax incentive companies are this issue should be taken seriously. Number one is the penalty is already there, like as you mentioned, whether you have been audited or not, the first thing happen is the first round of defense is the penalty. The penalty is there. Then subsequently is the tax adjustments that they're going to do. So the taxpayer is actually going to suffer a lot on the pretext that they think that they don't have any problem because they have got tax incentives. So I think the mindset of all these tax incentive companies should change. They should actually not have this mindset that I'm exempted from everything. Right, Theresa?
Yeah, you are right. Previously, there's no additional tax, right? Like I said, because you are tax exempt. But now the penalty has changed. For, let's say, on TP adjustments, it is now a 5% surcharge, right? They call it a surcharge, and it's calculated based on 5% of the TP adjustment. So it no longer comes down. Previously, it was the tax payable, you see, right? So in arriving at the tax payable, then you look at whether you are subject to tax or not. But now, no, it's at the top, right? At the gross top line, right? The TP adjustment itself, I take 5%. So even if you're a tax holiday company, 100% tax exempt, that this surcharge will still apply if the IRB has grounds to make a TP adjustment. So then, interesting question is, when will IRB has grounds to make a TP adjustment? Well, you're a tax incentive company, so I guess your margins should all be quite high, right? So you wouldn't be suffering. I mean, I do have seen one or two, but I guess majority, most of the time, all these incentive companies, your margins will be quite good, right? So you shouldn't have a problem of not being at arm's length. So in just a little bit on how we consider arm's length, right? So basically, OECD talks about the interquartile range, the lower quartile to upper quartile. That means if you have your comparables, you line them up statistically, you look at the 25th percentile to the 75th percentile, that's the interquartile range. In Malaysia, IRB looks at the point, which is the median, the 50th percentile, as the arm's length point. So let's say the arm's length profits are 6%, and you're having profits of 7, 8%, then it's fine. You have no issue of being below the arm's length range. Okay, but for tax holiday companies, right? Then the question is, what if your profits are 20%? This arm's length profit is 6%, but your profits are 20%. So would there be a situation where much higher than, you know, the arm's length range, would that also, you know, form a TP adjustment or not? I think it would, right? So take, for example, APAs, right? Advanced pricing agreements. So we've negotiated a few for our clients, yeah? So in many of these APAs, if they are looking at TNMM, then usually the two authorities will agree on a range, interquartile range of results, okay? So where the flexibility is given for this range. So if you are below the lowest edge of the range, the adjustment will be made to the lowest edge. If you are above the highest edge, it will also be brought down to the highest edge. All right. So as long as your results are within the 25th and 75th percentile, generally that's considered to be arm's length. So the example that I gave just now, if the median is 6%, if let's say the upper quartile is 12%, but your results are 15%, so you have excess profits, right? Profits in excess of the highest point or the interquartile range, which is 12%, you have 15%. So you will have a 3% adjustment. So potentially there could be an adjustment as well. Okay, then of course, yeah. Once you have an adjustment, then the question is, will IRB, can IRB impose a surcharge as well on excess profits, right? Or, you know, will they, or, you know, can they? So if you look at the act and, you know, on surcharge, the section on surcharge, etc., any TP adjustment can be subject to the 5% surcharge. Okay, so so coming back to that point, you can't have it too low, below the arm's length range, below the 50th percentile. You can't have it too high as well. So if it's above the 75th percentile, IRB may treat that as not being arm's length as well and make an adjustment, especially for tax holiday companies. Normal companies without tax incentives, usually the IRB will not make adjustment downwards, right? But for tax incentive companies, I guess this could be a factor as well.
But Theresa, how about some companies, they could be very peculiar in nature. You can't find the comparables in Malaysia to prepare a proper TP documentation. And then they would have high profit margins, all right? Would IRB then consider this as an area of concern? Whereas if you ask the taxpayer will say, look, my system is very peculiar. I can't get it anywhere else. So therefore, I require such company to provide me the services. And that's the surcharge or the price that we have to take into account. So the IRB then consider this as, no, it's not within arm's length. Will they still apply the same provision, or will they listen to the taxpayer and probably give a consideration?
Well, the IRB has been quite reasonable so far, right? So in situations like this, taxpayer just have to, you know, you have to show proof, right, that you can't find local comparables. And if that is the case, right, if you can show proof, then they will allow you to use foreign comparables. All right. So if you can demonstrate that, well, your business is, you know, you don't have similar businesses in Malaysia, right, and you've done the search and you can't find similar businesses, etc., then they will actually consider that.
Well, Amnah, have you ever encountered such a situation?
Yeah, sometimes you don't have a similar business, but the transaction is a similar kind of transaction. Let's say engineering. So let's say you are building certain kind of machine which is special, which is not available in Malaysia. So they will look into another company which also building machine and what are the margin that the company is. So it's a kind of the same kind of activity for a different product, something like that.
Yeah,
we could do that.
I think the IRB has, you know, through so many years of audit, they have also come to realize that, like engineering, for example, if you Google engineering in the directories, you will find a lot, right? But what kind of engineering? It can vary from those that are very simple to those that are really, really complex. Then, of course, you know, the risk that you take, etc., right? And the technology that you use and all that, the profit margins can really vary. So to take one that's like MSC status company, which is like really high technology, and compare that with other normal engineers, etc., you can't really use that for comparison, right? So that's not acceptable. And I think IRB can see that more and more. So in our recent cases, they've actually also asked us to consider the competitors. You know, in the past, usually when we do a study, a benchmarking study, we can't include competitors, because most of the time they would also have related party transactions, yeah, purchases or sales or something, right? And because of that, you know, they are eliminated if the transactions are above a certain threshold, you see. But recently, the IRB has asked us to look at that as well. I think they come to realize that, look, this is a ringgit billion company, right? How can you take a 10 million ringgit company to compare, you know, in terms of the profitability, right? So sometimes it's based on volume, very high volume, but profits may not be as high. But on the other hand, like for MSC status companies, it may be really, really high tech, right? Compared to all the others, yeah, other service providers outside, yeah, in Malaysia, for example. So, you know, so this is where I think the people, I mean, the taxpayer themselves and the tax consultants would have to know what is acceptable to IRB, and then, you know, to see what you can do, right? So that you can best defend the transfer prices of the company.
So this is good news for companies that are having what they call a specialized skill or specialized services, that they don't really have to be worried about the arm's length rule if they cannot provide the comparables that are required. So basically, it goes back to tell the IRB the business model that they're doing and the kind of jobs they're doing to defend their what they call under oath provision of profits.
Correct. But then when you look at what is arm's length, there are many TP methods, right? So we're just talking generally about the TNMM, or the transactional net margin method, where we look at, you know, either net cost plus, or look at operating profit margin. You know, there are also other methods, you know, where, you know, they are the central entrepreneur, right? So then they will reward the others, and then they will keep all the profits to themselves, right? So I mean, there are other methods as well, yeah, that can be used. So it's up to the company to actually choose what's the appropriate method, yeah, and then you know, appropriate comparables if necessary, yeah, in order to support their case, right?
But what would be the for MSC status company or tax incentive company, what would be the best approach to take into account if you want to be safe?
It depends, yeah, because we look at the characterization of the company, right? So we look at the functions that they carry on, and I think most importantly, you look at the risks. So exactly what are they doing, and what's the relationship with the related party? Who is the one that actually controls or bears the risks, right? So that will be the entrepreneur, and that would take the residual. So the residual could be very high profits, or the residual could be a loss, you know, depending on, you know, the business, right? Because you're taking the business risk. Okay, so it depends on, you know, how the business turns out. Okay, so I think another important point about this is that not only, I mean, we're talking about how to determine whether the profits are arm's length or not arm's length. So if it's not arm's length, IRB will make an adjustment, apply a surcharge, etc. I think the greater concern would actually be, how does this impact their tax incentive, right? Because in the conditions, it says that you must comply, right? So if your results are not at arm's length, you are actually generally not complying with the arm's length principle, right? And not complying with the Malaysian TP legislation and so on. So also, what happens then? So if you go back to the incentive conditions, then generally, if you don't comply with any one of those conditions, then MDEC has a right to question you and ask for grounds and reasons why you're not complying. And if they're not happy with the reasons, etc., they can actually recommend to MOF to withdraw the incentive, right? So I think that would be a greater concern, right? So I think
taking that into account, Theresa, should TP become one of the criteria in applying for any tax incentives? That means at the point of doing your business plan and doing your forecast for the 5 years and so, should TP be, instead of just being encouraged to do, should it be one of the conditions that in order to avoid these issues that you have, so that those who actually apply for the status or for the incentive are actually the real players? So we need the real players. We need those who can add value to the development of the country, transfer technology or investment. I mean, those who are doing real work, they come in, they put in their TP documentation. So at the point of entry, if your documentations are all in order, that gives you a benchmarking defense in the future if you get audited by IRB. But at the moment, it's encouraged, all right? It's part of the required, but it's not paramount for them.
Yeah, I think it's up to the taxpayer, right? You don't have to be told by IRB to do this or that, right? I mean, that's up to you. Yeah. So for me, I would recommend that even at the point of applying for the incentive, the application, the numbers that you're going to put in the application form, etc., you should have already taken into consideration, right? What's the business model going to be like? What kind of pricing policies, transfer pricing policies are you going to be adopting, and things like that, right? So you should already be doing that. In fact, our guidelines talk about contemporaneous TP documentation. So contemporaneous meaning that before you enter into the transaction, you should already prepare TP documentation to consider what is an arm's length profit. You know what I mean? So they should already be doing that. But I think for most people, they wait till they get the approval and then start the business, and then only, they start preparing the TP documentation. So definitely having contemporaneous TP doc would definitely, help to defend their situation. But most importantly of all, perhaps MDEC can take this up with NCI as well, right? So when they look at the conditions, is this one of the conditions that would be material enough for them to withdraw the entire incentive? Or just allow IRB to make whatever adjustments to arm's length, right? I mean, that would be penalty enough, right? On the taxpayer, right? Collect whatever additional taxes, that you need to collect. But should that be affecting, the incentive as a whole? So probably this is one area that MDEC can then take it up, right? And see then, what they can do to help taxpayers.
Amnah, was there a practice that when any MSC company or tax incentive companies get audited or investigated by IRB, do you cross-check with the agency that gives them the incentive? Do you check their background or their business plan, what they were doing before that? Is there such a thing?
Yeah, one of the documents that we will ask is the approval letter from the agency that gives the incentive, either MIDA or MDEC or whatever, definitely. Because if you don't comply with the term and regulation, term of the incentive, we will recommend them to be withdrawal from the incentive. So definitely.
Yeah,
so Theresa, you're right.
Harjit, yeah, you were talking about communication, right, between the IRB and the agency that approves or processes the incentive application. I think from my experience, there is a lack of communication because, whatever is written there in the conditions, right, is always subject to interpretation. So when the conditions are laid down for taxpayer, the understanding between taxpayer and the agency is, one understanding. But when IRB comes in to audit, quite often, they look at it differently. I can give you one simple example, right? But resulted in the company having to pay up all the taxes because they wanted to withdraw the incentive, right? It can lead to that. And this is actually more on, even if you look at assets, right? So that is a common incentive, like you need to incur so much, right, on capital expenditure, all right, by a certain year or something. So when they look at it, you have additions and you have disposals, right? So in the 5 years, you're supposed to incur this much, 200 million or something on fixed assets. So if you look at only the additions, maybe it adds up to 200. But if you also minus, you start to deduct whatever they have disposed during the 5 years, for whatever reasons, right? That they dispose, then if it's short and it becomes 180, then the question is, okay, I have incurred 250, for example. Your condition is I need to incur 200. So I have actually spent 250. But because I disposed of some machines, I have changed the technology, I replaced the line or something like that, because of the disposal, then it falls short, right? It's 180. So in this condition, in this situation, would I consider to still have met or have not met?
Well, it's subject to interpretation, I think, then.
Exactly. So it's just an example. So there are many, there are many over the years that we have come across. So it's quite sad, right? For a taxpayer, to think that, oh, okay, I've got the tax holiday, enjoy the tax holiday. Sometimes the full 10 years, it's over. Few years later, IRB comes in to audit and then starts to, want to claw back everything, right? But, you've all done and dusted, right? Past 10 years, gone already, right? And then you start to come and, try and claw back the tax. So not very good. So I think there has to be, it can be better. Yeah, the communication can be better.
But sometimes, Theresa, even for Amnah, there are what they call innocent mistakes done. It's not deliberately done. it is done innocently without knowing. Most of, like I said, the mindset of these tax incentive companies are that they have got a kind of immunity, against all these income tax issues. And we also have seen issues when they actually go withholding tax issue, they don't comply. So apart from even transfer pricing, which is now the hot topic for the year, there are other tax issues that they also do not comply. On the pre-tax, they thought, I'm exempted across the board. So sometimes it's the interpretation and also the communication, as you mentioned, is very, very essential. So those who have got tax incentives, I think what's important for them is they need to consult their consultants and get an overview to exactly what are they getting into it and what are the qualifications they need to require. Because like for MSC companies, their quarterly reports, they need to put it in. All right, they got KPIs that they have to comply with, because if they got first 5 years, they don't comply with the KPIs given, there's also a possible withdrawal, even not taking TP into consideration. They can even do other form of withdrawals just because they have not complied. So apart from all this, I think, Theresa, you have done a very good presentation. I'm looking forward to hear from Amnah on the topics which I think it's very important, apart from TP audits, is the normal general audits that happens to, irrespective whether you're an MSC company or a non-MSC company. So, Amnah, I have a few questions for you, but probably you can give an overview, especially for these tax incentive companies. What do IRB look at when they actually pick up a file for this tax incentive company? Do you get a lead from some agencies? Is it a lead given, or is it through your normal what they call screening that you do, your risk analysis, or it is just by chance you pick up a company? So what are the probabilities of these companies being picked up from audit? Of course, you have left IRB, I know one, but I'm sure you can still share some of your experiences during your tenure. And it will be good for those who are listening us today to understand that there is this avenue whereby IRB will still audit you, even if you have not complied TP. Apart from TP, there are all the other audits that are also going at the moment. So, Amnah, I would like to hear from you. And Theresa, of course, you can chip in and share your experience too as well.
Yeah, sure.
Okay, in general, the objective of TP audit done by IRB is to ensure that the arm's length principle is being complied within the control transaction, and also to encourage compliance with the law and the regulation, and the case selection based on the amount of control transaction made between the company with the transactions with the significant transaction value. So before any other risk analysis is performed. So it's being done between different departments. That is Jabatan Pematuhan Cukai is the one who will select the cases, and the audit is done by Cawangan Cukai Multinational. So it's two different departments in Cawangan. So different person who select it and different person, different Cawangan will be doing the auditing. So there is to be fair. And during the audit, when the starting of the audit, the officer will issue a letter. It's called Surat Pemberitahuan Lawatan Pematuhan atau Surat Penentuan Permulaan Tempoh Penyelesaian Cukai. I'm saying this in Malay because the letter will be in Malay.
Yeah, that's for sure.
Okay, so they are given 14 days notification. So they have to require to submit the document, things normal one like GL, general ledger, and so on. And one of the most important document is the TP doc, transfer pricing documentation, and it's within 14 days. Otherwise, penalty will be charged, as what Theresa told us earlier. Okay, so there's a field audit, and also there is a desk audit. So in the field audit will be carried out at the business premises or at IRB office or any places where there is a compromise between these two, especially during MCO. So basically, we are not encouraged to go out. Okay. IRB did not encourage the officer to go out. So probably there's no field audit to the taxpayers' premises. And if there's no visit, surat penentuan permulaan tempoh penyelesaian kes, so they will give a letter when the audit started. They will be sent to the taxpayer. And IRB will review the business record, the relevant document, and determine the correct amount of income that need to be reported, and to ascertain the transfer pricing and the arm's length principle is being adopted. And taxpayer is required to maintain sufficient and complete record to enable the income or loss of the business to be determined. And taxpayer will be called to the IRB officer, but now we have Zoom meeting to discuss the finding of the issue. And taxpayer shall be notified in writing, surat penemuan semakan case, and it can be very lengthy. Okay. And after that, IRB will raise the additional assessment. Of course, there will be discussion before that. Even though taxpayer did not agree with some of the finding, they still can raise it under best judgment assessment. And IRB will impose penalty as Theresa told us just now.
So for MSC status or tax incentive companies, I believe the documents that they probably will request, IRB will request, is normally the letter of approval. You have got a tax incentive. Then they also would like to know when your incentive starts, because there's a pink form that has to be submitted to MIDA. And that's when MIDA gives you the duration, the 5 years. And above all, I believe they also will check into the line of approval. What are the activity that you've been approved from? Because if you just look at normal audit will go through on the pre-tax that is taxable. I think in this case, IRB has to first ascertain that whether the source or income declared, is it an exempt income or non-exempt income? Because if the source of the income is exempted and it complies with the line of approval, with what they've been approved for, then the revenue is not questionable, because the revenue is derived from an exempt source. So that's when Theresa mentioned the transfer pricing issue may come in to see whether is it arm's length or not arm's length, whether the profit is over declared, whether you have done some adjustments to your profits. But if it's a normal tax audit for an MSC or a tax incentive company, I think it's very important to those who have this incentive is to actually keep all the relevant document with them, the initial document of approval. They should also have the business plan that they have submitted to the relevant authorities, because that becomes a benchmarking as far as initial discussion is concerned. Then all the quarterly reports that they have submitted to MDEC or even to any agencies, they should have it to say that they have complied. The other important area which I've experienced when these audits happen is you have to be located at the cyber center. You must be at the location which has been approved. Because IRB has taken a very simple stand for some of the cases, or you are not at the cyber center. The moment you're not at a cyber center, you have actually disqualified the initial requirement. They tak tengok pun whether your income is exempted or not. No, they just go back by the simple issues like, are you located? Are you exercising your incentive within the right time frame? So these are the kind of things that,
number of employees too.
Yes. So these are the kind of things all these incentive companies should actually consider first before even putting into other defense. These are the basic documentation they should keep it, because if your documentation is in order, when you speak to them, you actually will explain to them, look, I've been approved for activity A, my income is derived from activity A, and therefore my source is actually exempted. So once your source is exempted, your P&L expenses are academic, unless you have got cross-border transaction, maybe withholding tax issues has to be taken into account. But apart from that, if you don't have a cross-border transaction, it's purely domestic transactions, all right? And if your revenue is exempted, then therefore the total profits in the account should not be even questioned by IRB, because it's exempted. And then, of course, that's where Theresa will have to come in and say that TP will be the area of consideration. So in the nutshell, if I can be corrected here, the way I look at it, I think TP becomes the main criteria here. for incentive companies. If you could initially pass the test. You could pass the test of doing the right activities. You could pass the test of being at the cyber center, but you could fail at the TP side if you have not done your TP documents correctly. Is that true?
Yeah, Datuk, I also like to when it is an incentive company and it has a related transaction with a local company, which is a related company, when the incentive company reported a margin or income higher than the accepted level, then it is like shifting profit, from, let's say, company A, if it's a local related company, and B is the incentive company. So some of the expenditure of company A become an income to a company B, which is incentive company. So that's when we have to look at the transfer pricing method there, because one is being the profit of A is being shifted to B. So that's why even though you are a tax incentive company, we still will be auditing when you have a related company in Malaysia or overseas also.
Yeah, I think Datuk Harjit, what Amnah has said, I've come across a situation as well. Both are in Malaysia. I mean, they're both subsidiaries of a multinational company, but both are in Malaysia. And they did some restructuring so that some of the business is transferred from one company, existing company, to a new company. New company gets a tax holiday, right? So when IRB came in for an audit, they actually put the two companies together, look at the total profits, and then they decided, using TP principles, how much profit should go to the company with tax holiday and how much, to the one without tax holiday. Of course, then IRB will be pushing for more profits to go to the one, without the tax holiday, the existing company. So then you look at the profit split, you look at, the number of functions that have actually been transferred, what's the risk that have actually been transferred, is it just on paper, or is there substance to support, the restructuring and so on. So I guess that's another area where IRB could come from as well. But you mentioned something earlier about withholding tax also, Datuk Harjit, because I think those TP and withholding tax will probably be the focus areas as well. So if they don't come in for an audit and the taxpayer just makes payment, right? I think the areas will be, that period where we had a change in the law and then we swap back again. So for a number of months, the law was different. So many taxpayers actually get caught where that is concerned. They were not aware and they did not comply. So that's one area where withholding tax is concerned. Another area is in an audit, usually you will look deeper, right? In terms of, let's say, for example, support services or IT support or IT management or whatever. But when you look deeper, I have seen, when you ask for a breakdown, then you see, hey, there's actually license fee payment inside as well, right? Services not subject to withholding tax, but license fee, then that part will be subject to withholding. So I guess TP and withholding tax will be, two popular areas that IRB can look into and probably have been looking into.
Yeah, you're right. You're right, Theresa, because TP and withholding tax go hand to hand. Since the income, if assuming we take the income as a source which is exempted, then obviously the TP issue and the withholding tax issue becomes the only area where IRB can actually consider to tax the taxpayer despite it being exempted. Now, I got one very interesting question. I want to pose to both of you. Now, with these tax incentives that the government of Malaysia gives to whether local companies or more for international companies, right, offshore, overseas companies, is there a loss to the government in terms of tax when incentives like this are given?
So we have to see it in the big umbrella. So for IRB, they always fight. They want tax, right? But MOF, they are seeing the whole umbrella. So they are just more than just tax for FDI to come in, So there is things like multiplier effect, So just by setting up a new industry or a new company in Malaysia, there will be a support system for that company. There will be employment. So the employee will pay tax. All the support to the business will also be paying tax. So it's not just tax by itself. So there is other thing that you have to think about the growth of the economy.
Correct.
That's a very good. That's a very good question.
Yeah.
Answer upon. Why I ask you this question is because up to 2018, we'll just look at MSC companies, right? They have generated income up to 472 billion. So if you look at it, I would not consider it as a loss. When you get 472 billion, it's gross. So like you rightfully say, Puan, there's a what you call economy of scale. When companies get incentive, they come to Malaysia, they employ people, they rent the place, they buy Malaysian product, they spend money in Malaysia. So in the supply chain, there could be, the company could be exempted, but all the people in the supply chain could be paying indirect or directly paying tax. And during the GST era, there was a GST tax applicable. So the reason I ask you this question is there is another, there's a talk that should we consider incentives moving forward? If there is no loss by giving incentive to all these companies, and we are actually indirectly generating revenue, so my view is that incentive should be there and it should be given, but probably we could do targeted incentives. We could look at companies that really could add value. It could be brand-based companies that could elevate the branding of MSC or even any other cyber centers that we have. We can create a better brand. So the reason I ask you this question is because there's always a talk that it's time to revamp our incentive, maybe restructure it, and don't give it to everyone. But if you look at the numbers, up to 2018, we have 472 billion. And I think the job created is more than 200,000 jobs has been created. So all these people are also paying taxes. So I believe that tax incentive should not be considered as a liability, but rather it could be looked at as an asset to the country.
That's right.
That's true. So hopefully with the MOF and IRB considering the effects of Pillar 2 on Malaysia, right? With a global minimum tax of 15%. So if we continue to give the incentives, will we lose out or not? But I think based on recent seminars that I've heard from MOF, what they have said is that on the net, we actually have a net gain, not a huge gain, not 0.3 to 0.5%. Gain, but at least it's not a loss, right? And there are other factors as well. So it depends on how and what Malaysia implements. So we may still be able to hang on to incentives, but like Datuk Harjit says, I think we have to be selective, right? And really go for targeted incentives.
Maybe also they could give different kind of incentive, like places to do the business, like giving a land or whatever for them to build factories, those kind of incentive rather than just the tax rate. They have to think other incentive.
I think that they have done, like Penang, even in Cyberjaya and all that. I think that's something that they have been doing as well.
Yeah, that could be part of the extended incentive that they could probably consider. Instead of focusing on developed areas, they should go to the developing areas concerned. So, Puan Amnah, going back to this tax audit, which is, again, like I said, a very, very interesting session for most companies. Apart from keeping documentation, apart from having the TP documentation to be prepared by the taxpayer, would taxpayer need to be proactive in terms of their documentation keeping? Do they have to be like, have all the documentation in order so that when the tax audit happens, they are actually not caught off guard, they should be like, be prepared before the tax audit actually happens?
There is focus by IRB on certain industry like intensive tax incentive company, for intellectual properties, companies, disposal of IP, group restructuring, non-taxable income, reported losses continuously, digital economy, and one other thing which not just apply to MSC company, to any company that has not been audited before. And those are one of the criteria. So just expect that they will run the computer. This company has never been audited before, and you will be picked up. So be ready. Be ready. So it's like a norm already to be audited at least once in 5 years. That's the norm. 20%. Yeah.
Yeah.
Okay.
Yeah, I think Dr. Harjit, I agree with you. Documentation is key, right? And we're not talking only about the official TP doc or anything like that, but your, second tier, third tier documents as well, right? Your agreements, intercompany agreements, your contracts with your customers, other than just your incentive and qualification and all that, right? But your business papers and all that are important as well, yeah, for you to prove any kind of defense that you want to make to the authorities and so on. So that is always a challenge for taxpayers, right? With turnover, staff turnover, and all that. Sometimes people don't keep track. So it's good to actually see how to have an archive just for tax or something, right? So anything that's relevant for tax and everything stays there. So whoever your people can come and go, but at least you have your archive for tax, and people will know where to find things. So that's really helpful, because without documents, I think in an audit defense, your defense will definitely be weaker.
Yeah, you're right. Apon, have you ever experienced any tax incentive company being investigated apart from normal audit?
Yeah, usually there's a related transaction, of course, MSC company who has a related company. So let's say this is company who the product is some software, right? And they only sell the software to only related company and not to other company, things like that. So let's say the company keeping information about a hospital patient, and so instead of selling the software to all the hospital, you only to sell only one company, and every patient's information that being stored is become the revenue for that company. So it's sort of form of a substance in the approval. It says something else, development of software for keeping information of patient. But when come to the real audit, when come to audit, the charges are different, things like that. Many other companies also is like that. When the sales of is only to related company and not any other company, so adjustment usually made. So even though you are an MSC company, you still be related. So another thing is when we audit company A, and there is a company, related company, which is tax incentive company, it's definitely will be audited together.
So basically, the two companies will be audited together. Both the incentive company and the related company.
Yeah.
Right.
Hardly we would audit an MSC company which has there's no related transaction, so there's no TP issue, right? If there's no TP issue, and it's MSC, so there's no point, because if we audit and all the incomes are non-taxable, so that's the point of auditing. It becomes academic.
But I'm surprised the investigation will pick this up, right? Because investigation will pick more serious anti-avoidance issues and things like that. So for these, but I guess investigation branches have been doing normal audits for a few years already now, right? Not so much of investigation work, but more of tax audit work, right? So so more of that, not so much of investigating an MSC company. Have you come across that where it's actually taken up by the investigation branch as an investigation, not as an audit?
Well, I've experienced one. It has been picked up by the department which does investigation. So it's quite surprising why they pick up such a company when we don't foresee any issues. but it could be because of cross-border transactions. So that could be one of the areas of concern. But to be picked up by a division that specializes in looking at investigation is a bit strange. But like, nevertheless, Amnah said that if they have such a guideline internally, then probably they will do it. I think what's important here, Theresa and Amnah, is for those who are listening, it's they have to be ready, irrespective to how well your documentation are. If you have got TP documents, of course, it's good, but it's good to review them from time to time if there's change in your business model. Those who have never been picked up for tax audit, they should be ready for it also. Because if you were to extend your, say, your first 5 years has expired, and then when you extend the next 5 years, IRB is also is part of the panel. So maybe they could also look into it and say, look, this company has never been audited before. Let's look at them and audit them as well, to just comply the basic audit requirement that every company has to be audited at least once in a lifetime if it doesn't happen on a regular basis. So for those who have tax incentive companies and related party transactions, these are the areas of concern. Your documentation, make sure you have them well. Agreements are very important. TP documents are important. Cross-border transactions, you have to make sure if the element of withholding tax is applicable, they have to consider that, and they have to pay it according to the provision of the withholding tax. And at the same time, what is important here is do what you've been approved for. You know, try not to change your business model. And if you are intending to change your business, then I think MDEC or any agencies that have given you the approval has to be notified. You cannot change your business and not notifying these agencies, because as far as the data is concerned, they only have what they have approved you for. So the documentation and the notification is very, very important. Change of shareholders is very important. You have to notify the agencies that's given you the incentive that these are the new shareholders. Probably there could be a takeover of the company. This has to be notified as well. And rightfully, like what Theresa mentioned, transfer pricing, I think, Theresa, you will have a lot of work coming forward, since TP is becoming a very, very important issue as far as the law is concerned. So with that, Theresa, do you have anything to add?
I think, like I mentioned earlier, I think it will be good for MDEC to take up, some of the matters that I've raised, right, with NCI, with IRB, provide a bit more certainty to taxpayers with MSC status incentives.
Yeah. For Amnah?
Now, IRB strategy to improve service delivery system to encourage voluntary compliance and taking necessary audit or investigation action for non-compliance. So IRB also is already developed a system to collect as much information as possible about taxpayer. So you should be aware of that and stay safe and make sure you keep your document.
Yeah, I think that's the gist of the whole discussion we have today, is practically keeping a document in order, understanding of business, understanding the tax issues. As the topic today is on tax management, so managing your tax affairs are very, very important. When you have profits and you don't manage your tax, then penalty become an additional cost to the business, and it's not good to be always been flagged as a company that does not do compliance, because it will always be in the system, so it's a cost to the companies, and the companies should always consider managing their affairs well. MDEC has done well for the last 25 years, right from the day of incorporation, 1996 till today. We know that they are bringing a lot of business and also incentives, investments to the country. We would like to wish them another 25 years or more moving forward, and we'd like to thank them for giving us this opportunity to share this topic today, which I feel is very, very important. We have good speakers like Theresa Go, who is a senior partner with Deloitte, and Amnah was formerly and with IRB and now an executive director of HSS Advisory, and myself, Harjit Singh, who is also the CEO of HSS Advisory. We believe that this session will add value to your consumption, and if you have any issues, feel free to contact us, and then we will be able to advise you accordingly. So with that, we thank MDEC, and we also thank Malaysia Tech Month for the month, for giving us this opportunity to speak today. With that, we thank you very much.
Yeah. Thank you.
Thank you, Dr. Harjit, and our panel members for that interesting discussion, which is close to the heart of business owners, saving money on taxes. We'll now be moving to the next session of the day. It will begin very shortly. So do click join session and complete the survey for each of the session for us to continuously serve you better. See you in a bit.